Today, Betterment manages $30 billion for 600,000 customers all across the US. And we describe Betterment as all the things a great advisor would do for you if you had one, but smarter, faster, cheaper, better than the typical advisor would be.
Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay Ventures. On this podcast, I interview innovators about their strategies, industries, and decisions. On today's show, I chat with Jon Stein, the founder and chairman of Betterment. Betterment is an investing platform that helps manage people's money. Now, I've been aware of this company for a long time. Jon and I actually went to business school at Columbia together in 2007, where he first told me about his vision. I didn't fully get it at the time, but like a true entrepreneur, Jon saw a path and was relentless. He never gave up. Betterment was the first no-fee trading platform, which was revolutionary when they launched in 2010. Since then, they've officially become a unicorn, and they currently manage over $30 billion of assets for over 600,000 customers. After 13 years at the helm, Jon recently stepped down from being the CEO and is now the chairman of the board. Here in the States, it's become strangely taboo for CEOs to step down, while in other countries, it's a sign of growth and development. I view Jon's move as a promotion, so this is something we're going to talk about today, and he's very candid about the transition and how he felt about it. He shares Betterment's founding story, how to navigate regulatory challenges, and a ton of other wisdom. I hope you enjoy. This episode is brought to you by Bowery Legal. Bowery Legal provides a complete range of legal services to high-growth companies. They do everything from formation, employment, partnership agreements, stock grants, corporate matters, and venture capital and debt financings. If you're interested in learning more, visit bowerylegal.com. I'm going to start off today by giving Jon's background for him, just a little bit, not his whole bio, and then we'll jump into some hopefully deeper, more interesting questions. So first, if you don't know who Jon is, you should. Jon is the co-founder and chairman of Betterment. He served as the company's CEO for 13 years. That's a long time. And if you're not aware of Betterment, you haven't been paying attention. The company has raised $275 million, has over 500,000 customers, and according to their website, manages $21 billion in assets at this point. It's very clearly a unicorn. Jon and I met early, a long time ago at Columbia Business School, too many years ago at this point, and we stayed in touch. He's brilliant, he's thoughtful, and I think we're going to learn something today. Jon, what did I miss?
Well, we managed 30 billion today. So we've grown 50% since that, what you're reading, which might be the website. That maybe
you got to update your website. This is this week.
It was a good Q1. It's been, I think things have been good. But otherwise, Thank you for that intro. That was awesome. And thanks to you for setting this up, and Will for helping us on the tech side.
Cool. So I want to jump in today, but I think it's important for everyone listening to start off with more context about you. Can you give everyone the overview on Betterment, what it does and where it is today?
Today, Betterment manages $30 billion for 600,000 customers all across the US. And we describe Betterment as all the things a great advisor would do for you if you had one, but smarter, faster, cheaper, better than the typical advisor would be. So we manage a lot of people's money. When we set out back in 2010, when we first launched, the product was super simple. It was just a portfolio of stocks and bonds designed to be appropriate for your age, and a couple of other inputs that you told us. And over the years, it's become so much more sophisticated in terms of the different goals that we help you save for, be it retirement or college or house down payment, and how we think about correctly matching assets to those goals, or the tax management that we do. We earn the average customer 1.38% per year more than if they were to invest on their own for free with no fees. Because of the tax alpha that we generate. So that adds up to 38% more cash in retirement for a Betterment customer versus somebody paying no fees somewhere else. So it's just it's an incredible value in a sophisticated advisory, tax management, guidance platform and I think the growth is a testament to that. Now, we also were lucky because we were early. We kind of got into fintech before fintech was a thing.
So just to make sure I understand, so it's mainly for retirement assets for folks listening, right? You're managing a lot of money, but is it mainly retirement or is it brokerage? Who's the profile, target customer? And when are they engaging Betterment to manage their money?
Customers come to Betterment when they have real money and they're starting to think about, okay, I need to make this, this matters to me now. This is not just gambling. This is not just playing around. This is an investment, and you're right. Retirement is our number one goal. College savings is a big one. And people, the average customer at Betterment has invested about $50,000 with Betterment. Now, there's no minimum, right? So people can come with literally $1 and you can set up an account. There's no minimum fees. And so it's very easy to get started. But it's also for people who have like real assets and are really trying to, are well on in their financial journeys. The typical customer, the average age is 37 of our customers. It's sort of older millennials would be an average. But we have customers who are 22 and like freshly graduated and just got a fancy new job. And we have customers who are 99 and, well into retirement and are living, drawing income off of their Betterment assets through our retirement income product. So we'll support you throughout that entire life cycle of investing. And, the reason that we've grown so much is that we give great customer aligned advice and guidance. We've grown through word of mouth. We've grown through press. We've grown through the fact that we're good for people. And I think that's our reputation, right? Like if you talk to people, like, I bet a lot of listeners are Betterment customers. We're known for being good. Not that we've done everything right, not that we haven't made mistakes or, people haven't had bad customer service experiences, but like by and large and on average, like we do right by people. And I think, that's been key to our success.
So you're not the evil empire.
No, we're the challengers. We're the good guys, Mark. We're the
right. I like that.
People's champion.
So, is there an index that you guys benchmark against when people are thinking about return profile? If they're looking at benchmark or to a Betterment, what should be, for money they want to get X yield on? How do they think about what to allocate with you guys?
So, the way I think about it is, we invest in the entire universe of liquid investable assets. Now, because of the efforts of, folks in fintech, that universe is perhaps expanding. Maybe you would start to include things like art or collectibles or, other things, crypto, in that sort of investable universe. Whether those things, which are kind of like categories of fancy commodities, is kind of a way that I think about them. They're not that dissimilar from like gold or real estate, but kind of newer niche versions of those things. Those are growing, but the vast majority of Americans' assets of consumer retail assets are in stocks, equities, and bonds, government and corporate debt. And why those two things? Because the markets for those things are vast and incredibly liquid and incredibly efficient and well regulated. And so they are the best, most efficient investments for most people. You pay less fees on them because they're so liquid. So it doesn't cost a lot to trade them. You can trust them more. They're less risky because they're highly regulated and scrutinized by the government. And so investors in those things have a lot of recourse and protection relative to other assets. So they're relatively safe investments. The yield on them, it's going to be what the stocks and bonds markets return in an average year, which, a long body of literature over many, many years would suggest something like 7% per year for like a 60-40 allocation of stocks and bonds. You're going to get a higher return with slightly more volatility if you're heavier in stocks, a lower return with less volatility if you're heavier in bonds. But it's pretty like boring, plain vanilla stuff. But it's also like, it's the sort of like, vegetables that, that sort of should make up most of any portfolio. And so I think of this as sort of like the 90% of what you should do with your money is put it in Betterment. And then if you want to have, like, if you want to go buy Tesla, if that's your jam, or GameStop or whatever, or crypto, do those kinds of things with that kind of like 10% money. And those are not things that we support on the Betterment platform. We're for like you're the core of your assets, the core of your portfolio.
Now, you mentioned the algorithm and the service has become very sophisticated, and you mentioned the tax trading strategy. Can you go through a couple of the things that are unique beyond buying stocks and bonds that kind of give secret sauce and extra yield to folks?
Sure. So one that's very widely known when you ask Betterment customers, why are you with Betterment? One thing that they often talk about is tax loss harvesting, that when markets are down, we'll automatically sell off an asset, generate, if we can, a tax loss, and then buy a similar asset that's just slightly different. Maybe it's not the S&P 500, but it's the Russell 1000 or whatever. It's just a similar enough asset that it's going to be highly correlated, but it counts as different for taxes. So you get some money that you can immediately offset against your current income on your taxes and roll forward if you can't use it all in that year. And so you get cash in your pocket. You're paying less tax, and you can invest that. You can spend it. Like it's just, and so we're generating alpha there through that. Another great one is that I think fewer people know about, but is actually possibly more powerful, is asset location. So what is asset location? We'll take your tax sensitive assets like high dividend paying stocks that throw off a lot of cash, and therefore, you pay tax when you make money. And we'll put those into your retirement accounts, like your IRAs, even better, your Roth IRA that you'll never pay tax on, or your Roth 401k. And the very best account is the HSA, which you can now get through Betterment as well. That's triple tax advantage. We'll automatically push money into the right buckets, and we'll put maybe the domestic stocks that have that are less tax sensitive, that have less dividend yield into your taxable portfolio. That alone is probably worth 0.7% per year on average over the long term.
I love that. And just for the folks listening, I've been a Betterment customer. It's just simple. You don't have to figure any of this stuff out. You kind of just click some buttons and it starts doing its magic. Why did you start Betterment? And I'm going to ask this question, even though it's a little loaded. If you'll recall, we were in an entrepreneurship class together, a VC class.
Yeah,
way
it was you, Mark.
Ago.
You inspired me to start Betterment.
In business school. And so I remember I was telling you an idea about an investing site that was really easy. No, I'm just kidding. I remember you were pitching me. You were telling me about this idea you had, and I don't think I got it. And now here you are. So why don't you tell everyone a little bit about kind of the problem you set out to solve?
Yeah, I was lucky enough in my first year at Columbia Business School to take what was, I think I was maybe the only first year student in that class, right? And Mark was a year ahead of me. And I was super lucky to, I think, be sitting next to you on the day that we were finding partners. And I was like, hey, will you be my partner? And you're like, who's this guy? Anyway, and so I felt, and I knew enough of, I don't know if I knew you already when I asked to be partners or what, but I quickly figured out that you were like one of the savviest guys in the class. Like Mark, for listeners who don't know, I remember during like breaks between class, like he would be just like chatting VC over coffee at like the little coffee shop like near campus with like the other like one or two kids who were like already like, had their VC jobs lined up. He was just like on that track, and it was like, it was very clear that you were well networked and a person to know. So I felt lucky to be partnered with you.
It's very nice of you.
And I, I did have this idea for Betterment when I came to Columbia, which was also weird and unique. Like, I should take maybe a step back and then I'll come back to Columbia and like that class. But when I graduated, I guess, high school, I was like, I'll be a journalist. And so I went into college thinking I'd be a journalist. And I started working at the paper, and I realized I didn't like the writing as much as I liked. I'd been the editor of the paper in high school. What I really liked was building the team and putting like people together. And I was like, yeah, that was fun. And so I ran the student grill in college, and I organized a bunch of house activities. And I like had this, like, I liked putting teams together, but I didn't know that I wanted to start a business. I had no idea. When I graduated, I took a post-bac pre-med year because I thought, well, maybe I'll be a doctor, and that would be fun. And eventually, after working in the hospital and realizing I didn't like blood, and working in the labs and realized I didn't like pipetting things, I was thinking I should start a business. I like bringing people together, but what? And I thought back to my freshman year of college when I'd taken economics, and I learned a lot about how I took from Marty Feldstein, who was an advisor to Presidents Reagan and Obama. It's sort of like different ends of the spectrum, but I learned that through really smart analysis and great policy, we can make the world a better place. We can help people be better off. And at the same time, I took a psychology class from this guy, Irv DeVore, behavioral psychology, who taught me that despite all our best intentions and all the right incentives, people do really stupid stuff. People have no idea. We get in our own way. And those two ideas have always been in my mind ever since. And I thought, it's obvious what people should do with their money. Like, I've learned what I should do with my money. I should invest it in the boring, stocks and bonds, and rebalance it every once in a while and be tax efficient with it. But then, along comes GameStop, and everyone wants in on that. And in my personal life, when I graduated, I was investing in stupid stuff. I was buying airline stocks after 9/11, and I also bought Enron on the way down. And I was just buying and trading stupid things. And I made some money on some things. I was gambling, and I lost some money on some things. And I knew better, or I should have known better, given the things I knew. But it just, all of these thoughts were swirling in my head, and I thought, I can help make what is this hard problem of what should I do with my money really easy for people. I can build an answer to that. I can do that. I know Vanguard's out there, but they're terrible at tech. ING Direct is out there. They're giving a palsy savings yield, and they have terrible investments, but a decent experience. What if I just combine those concepts? And so I, started talking about that idea, and I, was selling, people on it, and people were like, yeah, kind of your reaction of I don't know. It seems like not sure I see a market there. And my parents kind of reacted the same way when I told them I was going to start this company. And they were like, why don't you just keep going with your applications to business school? And so I walked into Columbia, coming back to that point in the story, being the one weird guy who wasn't interested in doing any sort of recruiting or anything. I was just I'm going to start this company. And so I walked into that class, first year of business school with you. And
that's awesome.
I was I want to do this. And you got to help me build out, one of the first business cases. And that was really helpful to me. So thank you.
Yeah, no, but so first of all, I didn't realize I was helpful at all. So I'm glad to hear that. But you came at this seeing a problem, right? Just the need for extreme simplicity. Is that the right way to think about it? Because I remember you pitching this business distilling down to a slider. It was more risk, less risk. And that was it.
Yep. When I was first concepting Betterment, I was building the entire thing in Excel. I was a consultant back then. I was a consultant to banks and brokers. So I was for 5 years after college. That's how I learned a lot about financial services. That's how I learned enough to have the confidence to be able to start a business in financial services. And when you're a consultant, everything you do is in Excel. At least it was back then. And I learned a little bit of Visual Basic, enough to kind of build a model. And I learned enough then that I could start coding in Flash, very simple stuff. And so I was building the site myself. I was the engineer. I was everything. And
I love that.
And so it had to be simple because that's all I knew. And also web tech was so simple back then. I mean, we were still using Flash for one thing. So that was a different era. It was before mobile, right? You didn't have to worry about mobile. You could just design for this one, screen size use case, and Flash made it really easy. The comps out there were terrible. A lot of people don't remember this, but Betterment was for one, and maybe people in the clubhouse will correct me if I'm wrong, but I haven't been caught on this yet. As far as I know, we were the first brokerage to be no minimum, no fee, no no, and so anyone could come and
those are
fractional
pretty
shares,
revolutionary concepts,
right? Like we
Those are
were
big
investing
concepts.
even $1, you could build a diversified portfolio across all these things, and so there was a ton of back end heavy lifting and innovation there to make that happen. We didn't have all the sort of like, picks and shovels things that are available now to sort of like make these things easier. And then on the front end, we were the first service to show you a projection of how your money might grow over time and like a range of outcomes. That now there was, there was financial engines for those who are like, who are going to keep me honest. I remember looking at them and thinking, well, that's a cool thing. But they did sort of like this, I don't know, Monte Carlo-ish, like, slow simulation at Betterment. You'd move that slider that you're talking about, Mark, and like this like animation would just pop and you could like wag the tail. I spent like more days, possibly weeks than I'd care to admit, working on perfecting that animation because I really wanted like the interface to sing.
That's great.
I wanted it to feel like a different thing, like this, like very like fun user experience to like kind of play with your allocation and see what the future might look like. Because people hate thinking about the future. Gosh, like we're sort of evolved in an environment where we think about what are we going to have for dinner tonight, not, am I going to retire okay?
I love that point. So it sounds like you were in a little bit of a bootstrap and you had been thinking about this for a long time. For those who don't know, people in entrepreneurship will often refer to the first stage of a business as the 0 to 1. That's a stage where you're kind of building, getting things on the rails. And I think 1 is probably when you've got revenue, the machine's working, and you're focusing more on doing more of it. That you have a single unit economic functioning for the business. It's working. An engine, complete. What was the hardest part about 0 to 1 at Betterment?
Regulatory approvals was the hardest thing. We building this service was hard, but once, it was linear, it was just something that we knew we could do. We could launch the thing and all kinds of, but like everyone kind of everyone who's starting a business understands these arguments of like, hey, should we work on the sign up or should we work on the, like this part of the service or that? The regulatory thing was just a huge unknown. So I didn't know when I started out if we would be a bank or a mutual fund or, there's a broker, an investment advisor, none of these. Ideally, it would have been none of the above. We would have just been like this unregulated entity that's helping people do the right thing with their money. Like, I was like, trust us. And I bought all these legal books. I had a whole shelf of them. And I was reading and derivatives law and all these things. And there's no way around like U.S. securities regulation. Now, maybe, Bitcoin got through, and before anyone caught them, they sort of snuck in there. But it's kind of crazy that they did, because it's really hard to kind of get away from securities regulation, and that's a good thing. Like this is it. This is generally that like we want these markets to be well regulated. It protects investors. So we had to be something. We had to kind of choose. And I found the investment advisor is a great way to go. But because when you're an investment advisor, you have to have a clearing firm. We couldn't, and we went to all these clearing firms and they'd say, yeah, we'd love to do your business. It's going to be $100 to open every account and it's going to be $10 per trade. And if you want to have no minimums, and that was a sticking point for me, it just doesn't work. You can't possibly. I was like, how about nothing? How about we pay nothing for that service? Because you're literally it's just data. Yeah. It's like you're not doing anything. I'm not asking you to pick up the phone. I just want you to create an account. Like, why does that cost $100? So we had to build that. We had to build our own custody record keeping system. Like that was a lot of code, but that was linear. Getting approval from the regulators to operate that system was tricky. And we had, we were two or three people. And we had to go and present to FINRA and say, yes, trust us. We have all the money is here and we know it's all here. And to their great credit, to the credit of America and to the, system of government and system of, corporate regulation that we have, it happened. Like, people talk about how hard it is and, and it was really hard, but it's not like this is not a third world country where the only way to get there is through connections. Listen, I've had all kinds of privileges and, I am a very fortunate person. So don't get me wrong when I say this, but like I didn't have connections or like some kind of to the regulators. We were just, independent citizens trying to start a company, and like to get through that process took a long, long time. It took over a year. It was uncertain that we would get approval to do it. And when we finally got approval, it was only because we were going on TechCrunch like the next day. And we had this forcing mechanism, like, we have to launch this product. And I've been telling them for weeks that this was coming. And it was like, we need approval. And, to their great credit, they gave us approval on the Friday before we launched on Monday.
So that actually worked.
TechCrunch Disrupt. It worked.
Because I imagine these bureaucratic processes where, the paperwork is stuck on somebody's desk and totally. They can't do anything. Their hands are tied for some reason. But it sounds like if you give them a deadline, they walk down the hall, they got the paperwork done, and you got a stamp on something.
Totally.
Right? So it means they can't actually move it forward when they want to. There's control.
That's right. And there's a lot of discretion, and like, this is where, like I do have to recognize that like, I've had a lot of privilege and I'm fortunate in life because there is like always a human element to these things.
Right.
And in Betterment, in our team, in our backgrounds, in our bios, they sort of saw enough to like credible to be like, yeah, okay, we can trust this and we can keep an eye on it.
Right. Now, there's a debate that people have when they have to go through regulatory approvals of whether to launch preemptively. Hey, this thing's kind of stood up. We'll start operating as we're getting licensed, or to wait until you're fully licensed. Sounds like you waited. Why?
We have this philosophy of just doing things the right way. And I think particularly when you want to earn people's trust and manage their money, it's important that you establish a track record and a culture and a mission of like doing right by the customer, doing right by all parties. And I think in financial services, there's just not a lot of room for, in my view, like kind of like the cowboy, bad actors. I think, sure, that you can build a business, but you very quickly get regulated away. And even some of the current, kinds of things that, are maybe glowing hot, I don't get excited about. I take a long view, and in the long term, the things that tend to be, the best businesses are kind of the most boring businesses. Like they're the ones that, follow the rules and like grow and like, do right by their customers and like constantly invest in creating more value. It's just work. And it may not be the flashiest thing, but I think it creates like real long-term value.
What was the worst part about the process, company building in the 0 to 1 phase for you?
The worst part, like it was pretty fun, to be honest. I had a great time back then. We had this little office on Union Square. We were like doing this thing that nobody in New York was doing. I mean, it's kind of hard to you remember this time well, like when you were in VC in New York, and there weren't a lot of VCs in New York. And
there were less than a dozen at the time.
Yeah. I knew them all, right? And so it was kind of like a small community. There was no fintech. That was not a thing that existed. There were very few startups in New York. I used to go to the New York Tech Meetup, and there would be 50 people there, and that was like the entire New York tech community of like founders and entrepreneurs and all those kinds of things. And and there were other entrepreneurs at Columbia, but it was kind of like it just felt like, it wasn't like a focus. They were trying to grow it, like to the credit of the school, they were investing in it and growing the program, but it was maybe not the most popular curriculum. So it was kind of a fun time. I mean, we had meetings that we'd walk around Union Square and go to coffee shop, and it just felt like we were really onto something. I felt at the time like this is going to be big. We're in a moment. And everyone said to me back then, this was, when I was first, we launched in 2010, but remember the mortgage bubble burst in 2008 and 9, and things were real bad in financial services.
Yeah, it's ugly.
At that time, everyone was saying, like, why would you be in financial services? Like, this is a terrible spot to be starting a business. And I think we're so lucky that we got started at that time. If we hadn't, we would have been lagging somebody else who would have seen, this obvious idea that we were pursuing of building a next generation, customer aligned investment platform.
Yeah, I'm with you. I'm a contrarian in that I think as industries get decimated, that's when you want to kind of fill the gap, fill the void. Financial services aren't going away. It just needs to be redone. I'm with you on that.
I agree. So look, and I worry today about, all the buzziness in the markets, and the contrarian in me is nervous, given what I see.
You're talking about the market kind of hitting peaks and high valuations, et cetera?
100%. And listen, we don't time the market.
Yep.
I don't time. I'm not trying to today. I'm not say, my retirement assets are invested for the long term. They're invested the same way that they were 4 years ago and 10 years ago. And that's sort of the way it should be. But in my sort of personal life, I have a lot of exposure to the market through my equity in Betterment, right? Like we have, I have a high beta, sort of asset there. And so when I think about like, what do I want to do with like the little bit of like liquidity that I have from the company, it's like, I'm not like looking to go out and like, throw it all in stocks today or all in like sort of like early stage startups. I'm helping companies. I'm really enjoying that and advising folks. I'm having a lot of fun with that right now. But I do get worried about the kind of state of valuations in the world.
It's interesting. So I read Howard Marks. Are you familiar with him? He's a legendary hedge fund investor. And he writes I want to say it's almost monthly letter, which a lot of these hedge fund investors do. He's iconic. I mean, I'm probably going to get the facts wrong, but I believe he dumped $10 billion of capital into the market at the bottom in 2008. Something like that, right? So he really knows what he's doing.
He's up there with Buffett.
He's in that zone, for those who don't know him. He's one of his insights, which I think was very telling recently in one of his letters, was that he doesn't think the market's overvalued. Now, I'm paraphrasing him here, so I'm sure if he's listening to this, which I'm sure he's not, he might correct me on a few things. His point was the increased prices actually reflect inflation, that the Fed and the government has dumped so much money in that everything's going up. I saw the first report today, too, that the consumer index has stepped up. So it means there's inflation for basic household goods. And this is a thing I've been hearing for a while, that there's actually two levels of inflation. There's inflation in the market, and there's kind of an inflation for people with assets. And there's an inflation rate for people without the assets. The haves and the have-nots have different inflation rates. So his point was, if you adjust for that, the valuations are still in the band of reason, which I found very telling. And that was, I think the conclusion from it was, it's not a good or a bad time to invest, but it's not something you should be fleeing or expect a short-term crash. Do any of that resonate with you? I mean, I'm sure you're dealing with your chief investment officer and all these people all the time, and you're paying more attention to the market than I am. Thoughts?
It absolutely resonates, and I worry about inflation. Like I won't be the only person to talk about it, and inflation will come when, as soon as enough people believe it's coming. That's when you'll start to see it in prices. And I agree that it's possible that we've already seen some of it, and we've sort of built it into future equity prices. But I worry about it because we haven't lived in a world of inflation and most of our lives, and so I just I don't have that kind of like. I was born in 1979 when the last inflationary period was maybe close to its peak and kind of coming down through the 80s. Things were getting better, and so I just don't have like firsthand experience. I don't know what it's like, and I worry a little bit about that world and how to invest through it is something that we spend a lot of time thinking about.
I think this is one of the big motivations for the crypto market, right? one of the major drivers for inflation for folks listening is government printing money. When there's just a greater supply of dollars, it takes more dollars to buy things. That's inflation. One of the big thought pieces behind Bitcoin was that a government doesn't own the currency. They can't make more of it. There's a fixed supply. Crypto's obviously picked up a lot lately, Jon. How do you think that plays into the overall world of finance? Do you think it's an asset that every family should own?
I was listening to an older Planet Money this week on inflation, and they were revisiting the idea that money supply is a contributor to inflation. It's very logical. You and I learned it in economics, and it makes a lot of sense. But the newer text, I won't say 100%. Like who knows what percentage of professors think this way? But my takeaway from the episode was like kind of where like the industry is or the state of the art is that money supply doesn't really drive inflation. It's expectations about future inflation that drive inflation, because we've had huge increases to the money supply and shocks and long-term increases, and it hasn't materialized. So it's hard to say that's the driver. So therefore, do I believe that money supply is linked directly to the value of the currency? No, I think there's a lot of other things. And I would take that into the crypto example as well. The supply is not what's driving the run up in prices. It's not like supply has suddenly been constrained and then the price shot up. It's just expectations about future value. People believe that Bitcoin will be, and other whatever your crypto of choice is, will be increasingly accepted, increasingly part of normal society, or and you'll be able to use it to buy hamburgers and shampoo, not just things on the dark web. And I'm here for that. I think that's fine. I'm not sure that I believe that in that world where crypto is, incredibly more accepted, that Bitcoin or any one of the kind of like stores of value that exists today are the, continue to be the stores of value that they are at this moment. And maybe they have another 100x to grow from here. I wouldn't have predicted the growth to date. So don't listen to me on this, but I also just don't see a lot of competitive barriers to other things coming out. And like why is that a store of value? There is what I believe is that like generally assets that appreciate have some intrinsic value. Even gold, which is maybe like people are like, oh, crypto's like gold. I mean, gold has some value, be it in jewelry or in manufacturing or something. But definitely real estate, stocks, bonds, and these kinds of things have like real value. Crypto just doesn't. And
but neither does a US dollar, right? It doesn't have an intrinsic value, right? It's just a piece of paper. Correct. Or a digital asset. Now, that's totally right. It is an imaginary thing, and yet it is. Yuval Harari calls it intersubjective reality.
The U.S. government. It has that additional piece, and there's only one U.S. government, and Bitcoin is backed by a bunch of like people saying Bitcoin is valuable. So and there's only one of those, and I get it. Listen.
So, but if you're in a country with a dictator, I just think
you could start your own thing.
Right.
And, a lot of people have tried, and eventually I don't know that I see like real barriers. So
you're comparing it though to the US government. The point I wanted to make is if you're in a country where the government's changed 6 times in the last 6 decades, and there's a dictator at the helm, and they print money whenever they want to buy more arms, I'm making the most god-awful scenario you can imagine. The idea of something not controlled by anybody, but an algorithm, might seem safer than something with human hands on it. Interesting.
I'm sure to many people it does.
Are you holding Bitcoin? Are you an owner?
I am not. No.
Interesting. Fascinating. Okay. So Bitcoin will not be showing up on Betterment's platform anytime soon, I assume.
Well, no, so it might, right? Like, because I think there's enough people who do want it, and where I would like, what's a responsible way to invest in these kinds of assets? I said it, early, like you want 90% in these kinds of things and 10% over there. Part of the challenge of investing in Bitcoin has been or investing in crypto has been, diversified liquid access, right? Like, if you want to invest in a basket of things, like that maybe makes more sense than like picking one. And those products are coming, right? Like they're here or about to be here, and so I think you'll see more ways to kind of responsibly invest. And that's also, by the way, the expectation of that coming has been driving the price of these assets up too.
I'm going to change topics for a second here. Thank you for thoughts on Bitcoin and crypto. You've recently made a move, right? You've transitioned from the CEO of Betterment to the chairman. And interestingly, I view that as a promotion. And I think there's complicated perspectives around that transition in the market. And it varies, interestingly, by country. I was talking to someone recently who is Israeli, and they were saying, in Israel, someone leaves the CEO role, no one cares. You're just going to the role where you're best suited at that moment in time. It's about the company. But in the States, it's loaded, where we tend to have a lot more context and implications and judgments, good and bad, on stuff. How did that transition go for you? What was your mindset as you went through it? I want to ask you a couple of questions on this, because I think this is a really important concept for folks. I think a lot of people are afraid to stop being CEO. And I don't know that that's logical or even rational. I think it's a fantastic move. So please tell us a little bit more, if you don't mind.
I put myself in that bucket, maybe, of people who are like afraid to stop. And I agree with like the, maybe you said it was an Israeli sentiment of it sort of being like a logical, next step or the right role at the right time. Like a metaphor that came to my mind in the last week, because this is a recent thing for me, right? And I'll go into a little bit more the backstory, but I transitioned end of December, Jan 1, basically. I became the chairman, and Sarah is the full-time CEO. And I thought it's kind of like your kids graduating. I mean, people ask me, how could you leave Betterment? Like this company that you love so much. It was like your first child, and it's true. And all of that is true. And I love it very much, still. And I love all the team, and I love everything that we do. But the company is in better hands now. and the company is like, the team is in better hands, and the mission, remains. And it's a little like, I can't teach my kids everything, and so it's good that, they get to go off to college or they get to go to school. Like, of course, like I love them. And of course, like I want to do the best I can for them and be there for them. But like, it doesn't, like, I'm not everything to them. So
Right.
I guess, like, to go back to the story, I'd been thinking for, let's say, a long time about like what succession would be like. I mean, I remember when I started the company and we took our Series A, I was, at that time, I remember thinking about, now I have a board, and like I serve at the pleasure of the board, and someday like we might find somebody who can do this better. And, over time, I remember periodically kind of like bringing up the idea of like, maybe someday we want to find somebody else like who can like take the company forward. And I always got like, oh, no, like, like you're a founder CEO, like, and I used to tell this like metaphor that is telling of being on a startup. I said this all the time to so many people, and you'll probably see it in interview notes here and there, but that like being a founding CEO is like being on a roller coaster, and lots of people use that metaphor. There's like great highs and like great lows, but like the thing I always thought was particularly apt is like, and you can't get off. You're stuck
Right.
in until the end of the ride.
Right. I love that.
And and I was talking about a year and a half ago, I think it could be a little longer, to a good friend of mine who stepped down from his company around that time, and I was shocked. I was just like, wow, like whoa. and it had this, and he was so happy. And he was like, I just told them, like, and it was this process. He had to kind of like come to the point where he was like I'm going to do this. And like, we were with other friends and like a lot of like other founders, and a lot of people were like, like we're all asking questions about like, how could you do that? And, it just made so much sense when he explained his reasoning, and like, just like, he was ready for the next thing. And I had been interviewing a number of executives, knowing that I wanted some kind of additional, like, partner or somebody like at my level who could be a successor for the last year plus. And COVID was actually a great time to go through that process. It's like I met maybe 100 senior executives in the last year. It's so cool because you can call up anybody. And they're, you don't have to like fly around the country to meet folks, and, schedules are just so much easier. So I found it great. And in that context, in the context of hiring a CRO, Chief Revenue Officer, or COO, I met Sarah Levy in the spring of 2020. And she had recently been the COO at Viacom, which is a huge, big company managing tens of thousands of folks in her org. She started out there in Nickelodeon. And so we like to say, she's been marketing to millennials her entire life. And I was just immediately taken by her. And she likes to say, like, I ghosted her after that, which might be true. I might have like been interviewing like a bunch of people at the time, but like I was like, oh, she's really awesome. And like I quickly came around and invited her in as a consultant to Betterment. And fortunately, she took me up on that opportunity. And I love the sort of like try before you buy approach in general for all roles, but like particularly for like a super senior role, it feels really important to me. And to be honest, I don't think any of us, me, her, the board, were like positive when we started out, like that, this was going to be like the path. But I was just so impressed by her. Like she came in and, she was in our exec meetings, and I just saw us like having a better conversation and getting to a better place more quickly. And I just thought she should do this, like she's great. And so I'm really happy to report that the team seems happy, here, like, I'm knocking on wood because it's like early days, but the company's doing well. We grew 50% year over year in Q1, and
fantastic.
Like up from 40% year over year for last year. We're doing great. And she's like making smart investments in B2B. The 401k business at Betterment is like really booming. We're launching new products. HSAs continues to really deliver, and she keeps like expanding, checking savings functionality, all these things that like, she gets it. So I'm happy about how that's gone.
Advice for folks listening. There'll be, I'm sure, a lot of CEOs listening to this conversation. When is the right time to pass the baton? How do you think about that?
It's tough. It's a thing I thought a lot about. And, people have all different incentives, right? I remember talking to some folks, and it's a hard thing to talk about because what are you going to do? Like, you're going to go to your most trusted team members and say, I'm kind of tired. I kind of think I'm going to go, because like, they're not going to stick around. Like if in that environment where you're so, like, there's a lot of uncertainty around a transition like this. So it's delicate. It's a tricky thing to talk about with the board. How do you sort of say, because you're probably looking at them to like also invest in your next rounds, or like there's just so much uncertainty, and like what if things go sideways or you don't find the right person? So it's really hard. And I talked to my coach about it, like my exec coach. We were chatting about exec coaches just before the show started, and I'm catching up with him again tomorrow. But he said, don't you can't like go, like you are Betterment. Like that's what a good coach is supposed to do, I guess, is like sort of talk you up and like put you back in the game, and like go. I
don't know. They're supposed to get you where you're supposed to go, I think.
So it's tricky. Yeah. And what's my advice is be open. I don't think if I were still the CEO, like I'd be having a bad time. Like that was a great job. And I often, I've often said, I have like the best job. Like this is great. But I can also say, I've never been happier, right? Like I'm delighted with where things are for the company, for me personally. Like but I feel very lucky, very, very fortunate that that's the outcome. And it took a lot of work to kind of land that plane, not just from me, but from a lot of folks.
Tell us about landing the plane. What's the most important tip you can pass along to folks about how to navigate a transition at the top?
Hire the right person. I mean, it's all people. It's like everything. It comes back to people. And that's a tricky thing to know, as it is with any hire, but this is a particularly tricky one.
All right, we're going to shift on here. There's probably a lot of entrepreneurs who are going to listen to this. I'm assuming this is going to attract folks who are in the financial industry, fintech folks. What are areas of opportunity? Where should people be building? If you're an entrepreneur out there looking for a concept, where should they focus?
Yeah. I think there's so much work still to do in fintech. I'm just going to talk about fintech because that's what I know best. And oh my gosh, there's so many interesting things happening in biotech and AI, and like, please go innovate there if you know anything about, because we need you. We need smart people in those fields. But what I know is fintech, and there's so many problems that remain. Even though it seems like, wow, I'm like just floored by how much innovation there is compared to 10 years ago. There's still a lot to do in traditional financial services businesses. So number one, it is still, despite all the innovation, it's like kind of annoying to design, build, sell a home. Everything, it's pretty easy now to like get a mortgage. I feel like that process is, could definitely be more streamlined, but people are like working hard to streamline that. But wow, there's a lot of interesting innovation around, making, identifying the home, financing, remodeling it, all through digital technologies. Prop tech, I think, is super interesting. Insurance has been, talked ad nauseum, but having just, I just got life insurance using Policy Genius, a plug for my friend Jen, who runs them, and I thought they did great, but wow, the process is, the back end is still terrible, and like these big legacy, companies have not totally embraced the fintech revolution yet, and there's just more years and more miles to go there. Betterment, wow, we managed $30 billion, and like Coinbase just IPO'd, and what they say they manage, was it 90 billion, 200 billion? Like there was like maybe last year with 90 billion. It's like kind of an incredible number, like obviously inflated by the value of crypto these days. But these are tiny relative to the trillions of dollars of assets and so there's a lot of room left to grow in traditional businesses too. I think alts is a really interesting spot on the kind of wealth tech, or there's all this cool opportunities to invest in art and collectibles and fractional real estate, residential real estate. And I've always had a bit of a skeptical view towards these things. You heard me talking about, crypto. Like, that is another one of these, right? And like I have that same, but where we are now is the reason I was skeptical was because I think there's this adverse selection that for the retail investor going to invest in art or collectibles or even cryptocurrency, you don't really have an information advantage over the institution or the person who is spending full time doing that thing. I, as a casual, like as a CEO doing angel investments, would have no chance against you, Mark, the VC, who's like looking at deal flow and like networked and understands like the bigger picture. Professionals have an advantage in these niche investment markets. And so that's why I was skeptical. But I think increasingly I'm seeing access, democratized access to great managers, right? And that's interesting to me because we've reduced the cost of investment, we've reduced the cost of KYC, that opens up some more interesting like investment opportunities for that. Anyway, that's two. So traditional businesses is interesting. Alts is interesting. And then 3, people have talked a lot about picks and shovels investments like Plaid or what have you, Alloy, that as being like interesting. I know this is a common topic in fintech is like you want to build like the infrastructure layer that powers all these startups and gathers their venture dollars. I don't think we're done with that either, and I don't think it's like doing the same things that these other companies are doing. But I think it's interesting new data sources. So yes, like we've got your bank account and login credentials and like that. Like lots of people are doing that. And yes, we have your credit report. Credit Karma did an amazing job of kind of like making that available to folks. But there's so many interesting data sources that would be useful in providing a better financial and overall wellness to people, such as your taxes, which are kind of like over here and like hidden, in your tax software, but make that accessible to people, and you can do a lot of really intelligent and fun things for them off of that. Or your spending data, which a few people have tried, but I haven't really seen anyone do like great, awesome, intelligence based off my past spending. Health data, payroll is one that I'm like really excited. I'm advising a company and looking at another one that are kind of in and around this. What can we do if we know everything about your present and past payrolls? Like, how could we, help you save, borrow, all like there's a lot of great information. And so making that accessible, I think, is a really interesting opportunity.
Thank you for that. That was more than one area of focus. That's great.
Sorry.
No, it's great.
Got more.
Hopefully some people will be inspired to start some businesses from that. So, as far as entrepreneurship goes, you kind of won the game and you've got some free time now. Where does Jon Stein go over the next 10 years?
Today, I'm enjoying having free time for the first time in a long time. And I've got 2, pretty young kids, 5 and 6. And so enjoying, being dad, enjoying working on our house, and that it's just so nice. I mean, this kind of stuff it was always like what I would look forward to on the weekends, and I still feel really busy. Like it's not like I just get to do it all day every day. Like I'm doing a lot of work still during the days, but I'm enjoying getting to do more of those things that I love. And then what's keeping me occupied is really I love meeting founders. I love getting to know companies. I'm finding this curiosity that drew me to Betterment and to the opportunity in the first place is coming back. And I had, like I really had kind of had to put a lid on it and stop reading so much. And, of course, like, and just stop, like, put my head in the sand a little bit, because everything I looked at, if it wasn't directly relevant to Betterment, felt like cheating on Betterment, right? When you're the CEO, it's like, nope,
right.
like, you could always be doing 5% better, 2% better. And so just do that. Now I'm just enjoying, my leisurely exploration of the kind of broader areas of tech around what we've been doing. And I'm finding it so fun to help early stage entrepreneurs, right? Awesome. Their questions are cute, and should we go B2B or B2C? And I'm like, oh, one person was like, should I do both? And it was just really fun to say, don't try to start out doing both, just pick one, the kind of
right.
Fun, obvious stuff. So
that's fantastic. Thank you so much for making time and being on the show today.
Pleasure, Mark. Always great to see you. And
Likewise.
Thanks for doing this. It's a lot of fun to do.
Cool. Well, that was awesome. Huge thanks to Jon for sharing what he's done with Betterment. I particularly enjoyed the bit about navigating a highly regulated sector. That's become a pattern of advice on the pod and goes against the conventional wisdom that scrappy entrepreneurs follow. So I think it's super interesting and helpful. Hopefully you took that to heart. I'm excited to see what Jon does next. If you liked what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter @MPD. And to hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any major podcast platform. Just search for Innovation with Mark Peter Davis.